is Yossi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss REITs that I think will greatly suffer from the AI revolution. And therefore, if I own these REITs, I will consider selling them today before it's too late. But before I get started, I want to clarify that I actually think that most REITs will greatly benefit from the AI revolution. And there are three reasons for this. Firstly, I think that this will be highly deflationary, meaning that has the potential to greatly reduce the cost of most goods and services over time. Very deflationary, and therefore I think it will also bring lower interest rates, which will then lead to cap rate compression, higher property values, and higher NAVs for REITs. The second reason is that I think that this is going to significantly disrupt most businesses because it's breaking traditional barriers to entry. It's making it way easier to start almost any type of business, and therefore I think we'll see an explosion in new competition, hurting most businesses. And as this becomes clear to investors, I think that what we'll see happen is that more investors will want to allocate towards scarce assets that cannot be disrupted, and real estate is one of them. And so I think it's going to turn into this anti-AI asset class for wealth preservation. So we'll see more and more capital being allocated from the traditional stock market back to real estate and by association REITs. Third reason is that I think that this will lead to a boom in new entrepreneurship. I think that as the labor market gets disrupted, a lot of people lose their jobs and they struggle to find a new one. And at the same time, it's becoming easier than ever before to start a new business. We'll see an explosion in new small business formation, and this should benefit many property sectors, including industrial real estate, self-storage, data centers, obviously, but many others as well. By the way, I've discussed this entire topic at great length in a report that I recently posted at High Landlord, and you can read it for free. I've removed the paywall. It will be the first link in the description of this video. So if you want to learn more about how REITs benefit from AI and which are the biggest winners, make sure to read this article. Now we go to the topic of today's video. What REITs are going to suffer from the AI revolution? Because obviously the REIT sector is very vast and versatile. They invest in over 20 property sectors, and while there are some winners, there are going to be some losers as well. One of the big losers is obvious, it's office real estate, in my opinion. I think that this is going to lead to great disruption, especially for white labor jobs. Think of consultants, marketing, finance, accounting, so many others. I think that lawyers, I think that in many cases, we're simply not going to need as many of those people anymore in the future. You know, if you would take the example here of a law firm, perhaps maybe before they had 10 junior lawyers drafting contracts, maybe in the future they'll only have 2 of them plus the help of AI. That's how much more productive they are becoming with AI. And so if companies are employing less people because they are being so significantly augmented by AI, naturally they're also going to lease less office space. And it doesn't end there. The problem is that on top of that, because there's so much uncertainty about how much space they will need in the future, they will also require more flexible terms with the landlords. And I think that this is one more reason that's also going to lead to cap rate expansion in the future, because if you don't know how much space you need in 5 years, you cannot sign those 10-year leases anymore. Even signing a 5-year lease is going to feel very risky. And so tenants are going to require more flexible terms, likely lease less office space. The problem is that today vacancy rates are already at an all-time high at about 20%, and therefore the landlords don't hold the cards. It's the tenants who hold the cards. They have significant bargaining power today. And so they're going to require shorter lease terms, potentially for less space. And so I think you'll see NOI drop, occupancy rates drop, even as cap rates expand. And so that's a recipe for value destruction. Which office REITs will suffer the most? I think that all of them will do relatively poorly. I'm avoiding this space completely. I have a bit of exposure through a few mixed-use REITs like Armada Hofflers, but I think that those will suffer the most are likely those that are invested in big markets with significant office supply stocks and where rents are really high. A good example of that could be New York City as an example. Very expensive rents, significant supply, very high vacancy rates, heavy exposure to sectors like finance, law firms, consultants, and so on. I think it's Goldman Sachs CEO who recently said that these days 95% of the work involved in drafting new IPO prospectus can be done with AI. And before, it took a team of 6 people working weeks on it. It's just again shows you the scale of how much disruption will happen. And so what REITs would I avoid in this sector? I think that the most important one, in my opinion, to avoid would be those that are exposed to cities like New York. SL Green is one, ticker symbol SLG. Another one that comes to my mind is Vornado Realty, ticker symbol VNO. Another one is Boston Properties. It recently changed its name to BXP. It's the same as its ticker symbol. BXP is better diversified across the country, but again, it's mostly investing in this big market similar to New York, and it has heavy exposure to New York as well. So I would avoid those REITs. Second property sector I think to avoid would be certain types of retail REITs. And here you need to recognize that retail is vast. There's many subcategories in the retail property sector, and I'm actually very bullish on some of them. Service-oriented, grocery-anchored, necessity-oriented retail strip centers, I think will do just fine over time. There's a lack of supply. People will still go to grocery stores, they will still go to barber shops, go to local restaurants. I think that those properties will do just fine. I'm investing quite a few of them. I previously mentioned on this channel Ryokan up in Canada, or Kite Realty, or Whitestone REIT in the US. I'm very bullish on those REITs. However, I think that the lower quality malls as well as outlet centers could suffer quite a bit from the AI revolution, because I expect it to accelerate the growing trend of e-commerce. And why will it accelerate it? It comes down to two things. Shipping is going to become much cheaper and faster thanks to autonomous vehicles. And secondly, I think that the online marketing from these e-commerce companies is going to become even more powerful, because they will be able to have these highly personalized marketing campaigns that would be really convincing to get you to buy stuff. In big part thanks to AI analyzing data and helping them make better decisions. And so I think that e-commerce will take an even bigger share of your discretionary spending in the future. I think that the Class A malls, such as those of Macerich and Simon Property Group, will do just fine. However, I fear for the lower quality malls, such as those of CBL and Associates, or even the outlet centers like those of Tanger Factory Outlet, which are located typically in more rural locations. They rely on the lower pricing to try to draw in their traffic. But that 30-minute drive to the nearest outlet is going to feel much longer now if you can get free same-day shipping, and the marketing again of these online companies is going to become only stronger. So I would avoid Tanger and CBL. Before I go into the third property sector, can you please do me a huge favor and click the like button if you think this is valuable? Helps me a lot to keep producing this channel. Also, let me know in the comment section below what you think of the AI revolution and how it will impact real estate. Thank you very much. The third property sector I think will suffer, and I'm avoiding today, is that of hospitality, hotels and resorts, and two reasons why I think they will suffer. Firstly, I think that it will greatly empower the business of hosting, and so Airbnb I think is going to become even more common, because it's becoming easier to become a host now. You can, with the help of AI, have automated chatbots. You can have AI analyze for you new requests from potential tenants, make analysis if they want to approve or deny that request. It can also help further automate check-in, check-outs, and whatever you cannot automate, you can now outsource to a local property manager that will also be augmented by AI and likely be able to offer these services at a lower cost. And so I think we'll see even more people turn their properties into Airbnbs, at least partially when they're traveling or out of town, or maybe there's spare room. And so if there's more hosting, there's more supply of these properties, which puts pressure on the hotels. Second reason is that I think that this is going to lead to even more price transparency in the future in the hotel sector, because now you don't need to Google anymore to find the right property, or go to booking.com and study countless properties. Instead, AI will do it for you. You'll ask AI, give you just an example, you tell it that I'm going to Hawaii from this date to this date, and I'm looking for this type of hotel with a pool and a gym, and find me the best deal for this type of property, and it will do the work for you. And so it will lead to more price transparency. I think it will also reduce the value of having a famous flag like Hilton or Marriott. I think the value of these brands will potentially decrease in the future. And so it's going to put a lot of pressure on the hotels. At the very least, I think that this uncertainty caused by AI has the potential to lead to higher cap rates again, and so value destruction. Some hotel REITs are quite cheap today, despite owning great properties. If I was going to invest in this space, I would focus on REITs that own more resort-style properties that are better protected from the competition from Airbnb. You know, with also the risk of a near-term recession, I think that the valuations still today are not low enough to make them attractive for me relative to other property sectors that are much safer, more stable, but also discounted. So for this reason, I'm not investing in hotel REITs today. Fourth property sector, I'm less sure about. I think they will also suffer long-term from the AI revolution, but probably to a much lesser extent, is that of medical office buildings. I think AI is going to accelerate the trend of telemedicine, and so you'll have less routine visits perhaps for these medical office buildings. But on the flip side, this property sector enjoys other tailwinds like the rapidly aging population. And so I think overall this property sector will do just fine, especially in the coming years, but it's something to monitor closely. If telemedicine makes significant advancements, this could change everything for this property sector. So today I still own some stakes in some REITs that are allocated to this sector, but it's something I'm watching closely. So what does all of this mean for investors? And in short, you need to become more selective than ever, because I think we'll see growing disparities in performance from one property sector to another. In the past, maybe 20 years ago, we talked about commercial real estate and we put everything together, office, residential, industrial, retail, and we expected all of it to do more or less the same. Some will do better than the other, but it was one asset class. I think in the future we cannot talk about one asset class anymore. Real estate is becoming many asset classes, and you'll have one that will do really well while the other does really poorly. And office versus industrial is perhaps a great example. Office will greatly suffer, I think, from AI, whereas industrial could benefit significantly as it accelerates the growing trend of e-commerce, leading to more demand for space. At the same time, it accelerates the trend of onshoring, because now with AI and robotics, it's becoming more cost efficient to produce domestically, and so again, more demand for industrial properties. And so it will be very important that you make the right choices in what property sector you invest in the future, much more than in the past. Again, as I mentioned earlier, we've written a full report on this topic at High Yield Landlord. You can read it for free and learn much more about how AI is going to revolutionize real estate and REITs. It's the first link in the description. There's no paywall. Secondly, if you want to access my full REIT portfolio, all my best research in real time, including my REIT CEO interviews, you can join High Yield Landlord for a 2-week free trial. There will be the second link in the description. Once more, if you could please click the like button, subscribe to your channel. Helps me a lot to keep on growing. Thanks so much. Let me know in the comment section below what you think. See you at my next one. Bye-bye.